Every single day, the foreign exchange market trades roughly $7.5 trillion US. That is more in 24 hours than the London Stock Exchange handles in an entire year. And today, Tuesday the 16th of June 2026, is not an ordinary day in that market. We are sitting on the doorstep of a major central bank decision week, the kind of window where a single sentence from a policymaker can swing a currency pair by 100 pips in minutes. If you are trading euro to US dollar, pound sterling to US dollar to Japanese yen, or gold this week, the next few minutes could save you from a painful mistake. In this analysis, we will break down exactly where the major pairs stand, what is driving them, and how to position yourself with logic rather than luck. Let us set the scene properly, because price action never happens in a vacuum. Heading into mid-June 2026, the dominant theme across global markets remains the divergence between central banks. The US Federal Reserve, the European Central Bank and the Bank of England are all at different points in their policy cycles, and that gap in interest rate expectations is the single biggest force pushing currencies up or down. When one central bank is leaning towards cutting rates while another holds firm, money flows towards the higher yield, and that flow is what you see on your charts. Inflation data, employment figures, and growth surveys have all been feeding into these expectations. The key point for today is simple: traders are not reacting to where rates are now, they are positioning for where rates will be 6 months from now. Roughly 90% of all Forex transactions involve the US dollar on one side of the trade, which is why we always start with the greenback. The US dollar index, often called the DXY, measures the dollar against a basket of 6 major currencies, and it acts as a master switch for the entire market. When the index strengthens, euro to US dollar and pound sterling to US dollar typically fall, while US dollar to Japanese yen tends to rise. The dollar's direction this week hinges on two things: the tone of upcoming Federal Reserve communication and global risk appetite. Remember, the dollar wears two hats. It is both a yield play, attractive when US rates are high, and a safe haven, in demand when markets are frightened. Understanding which hat the market is responding to on any given day is half the battle of trading the majors correctly. Euro to US dollar accounts for around a fifth of all daily Forex volume, making it the most liquid and closely watched pair on the planet. As we analyze it on the 16th of June, the euro is caught between a recovering Eurozone economy and a still cautious European Central Bank. The technical picture is what matters for your entries. Watch the recent range carefully. When the pair is pressing against the upper boundary of its consolidation, sellers tend to appear, and when it dips towards support, buyers step back in. The smartest approach here is not to predict a breakout in advance but to wait for confirmation. A clean daily close above resistance opens the door to continuation, while a rejection from that level signals the range is still intact. Patience on this pair is rewarded, because false breakouts are common around big news. Pound sterling to US dollar, nicknamed cable after the transatlantic telegraph cable that once carried its quotes, is highly sensitive to UK economic data and Bank of England guidance. The pound has historically been one of the more volatile majors, capable of sharp intraday moves on inflation prints or wage growth figures. For the 16th of June, the pound's strength depends heavily on whether UK inflation is cooling fast enough to justify rate cuts, or staying sticky enough to keep the Bank of England on hold. A hawkish hold tends to support sterling, while clear signals of easing tend to weaken it. From a chart perspective, treat round numbers as psychological battlegrounds. Levels like 1.350 often attract heavy order flow, and price frequently stalls or reverses around them before choosing a direction. US dollar to Japanese yen deserves special attention because it sits at the heart of the global carry trade. For years, traders have borrowed cheaply in Japanese yen, where interest rates were ultra-low, and invested in higher-yielding currencies. That trade works beautifully until volatility spikes, and then it can unwind violently. The pair is driven primarily by the gap between US and Japanese government bond yields. When that yield gap widens, US dollar to Japanese yen climbs. When it narrows, the yen strengthens fast. Keep one eye on the Japanese authorities too, because the Ministry of Finance has a track record of intervening to support the yen when it weakens too quickly. Those interventions can reverse hundreds of pips in a single session, so this is not a pair to hold blindly through major news without a stop-loss in place. Gold, traded as XAU/USD, belongs in every Forex analysis because it moves in close relationship with the dollar and real interest rates. The rule of thumb is straightforward: gold tends to fall when real yields rise, because holding a metal that pays no interest becomes less attractive, and it tends to rise during fear, inflation worry or geopolitical tension. In 2026, central bank gold buying has remained a powerful structural support beneath the price, with official institutions continuing to diversify away from holding only dollars. For traders this week, gold offers a useful sentiment gauge. If gold is rallying while the dollar is also firm, it usually signals genuine risk aversion in the system. Treat sharp gold spikes as a warning that broader market stress may be building beneath the surface. Here is a truth most beginners learn the hard way: the actual data number matters far less than how it compares to expectations. Markets are forward-looking, so they price in the consensus forecast before the release. If inflation comes in at the level everyone expected, the reaction can be muted even if the headline looks dramatic. The real moves come from surprises, the gap between forecast and reality. Before any scheduled release this week, check the economic calendar, note the previous figure and the consensus forecast, and decide in advance how you will react to a beat or a miss. Never trade in the first 30 seconds after a major release, because spreads widen dramatically and price can whipsaw in both directions before settling on a true trend. Let me be honest about what prediction really means in trading, because anyone promising certainty is selling you a fantasy. Professional analysts do not predict a single outcome, they map out scenarios and assign probabilities. So for the dollar this week, think in branches. Scenario 1. If central bank communication leans hawkish, expect dollar strength, pressure on euro to US dollar and pound sterling to US dollar, and upside in US dollar to Japanese yen. Scenario 2. If the tone is dovish or growth data disappoints, expect the dollar to soften, the euro and pound to recover, and gold to push higher. Your job is not to guess which branch we take, but to have a plan ready for each one. This is the mindset that separates consistent traders from gamblers who simply pick a direction and hope. If there is one section to remember from this entire video, it is this one. The traders who survive are not the ones with the best predictions, they are the ones with the best risk control. A widely respected guideline is to risk no more than 1 to 2% of your account on any single trade. That means even a run of 5 or 6 losing trades barely dents your capital, leaving you with plenty of ammunition to recover. Always set your stop loss before you enter, based on the chart structure rather than on how much you are willing to lose emotionally. And aim for trades where your potential reward is at least twice your risk. With a 2-to-1 reward ratio, you can be wrong more often than you are right and still finish the month in profit. Timing your activity around the trading sessions can dramatically improve your results. The Forex market runs 24 hours, but liquidity is not constant. The overlap between the London and New York sessions, roughly from 1 in the afternoon to 5 in the evening UK time, is when volume and volatility peak, and it is often the best window for clean directional moves. The Asian session tends to be quieter and more range-bound. Mark your key support and resistance levels in advance on the daily and 4-hour charts, and let price come to you rather than chasing it. The biggest mistakes happen when traders force entries during low liquidity hours and then get caught in choppy, directionless price action that grinds their stops. So let us bring it all together. This week the market is being driven by central bank divergence, and the US dollar remains the conductor of the orchestra. Watch euro to US dollar around its range boundaries, respect the psychological levels on pound sterling to US dollar, keep a close eye on intervention risk in US dollar to Japanese yen, and use gold as your fear gauge. Above all, trade scenarios rather than certainties, and never let a single position threaten your account. The market will still be here tomorrow, next week and next year, so protecting your capital is what keeps you in the game long enough to win. Do your own analysis, wait for confirmation, and let high-probability setups come to you. Trade smart, stay disciplined, and let the data lead your decisions rather than your emotions.